And now introducing Mr. Keith Lanton.
Hi, good morning. It's Keith. Hope everybody had a wonderful last week of summer weekend. This morning is Monday, September 19th, and next week it'll be fall. And we're approaching the end of the third quarter of 2022, and in a few more weeks we'll be talking about earnings and hopefully not lack thereof. There is a lot to talk about this morning as we had a week last week in the financial markets where we saw stocks fall significantly. At the same time, bonds saw their yields rise, especially most pronounced on the shorter end of the yield curve. This morning, going to talk about perhaps why some of the effects that we're seeing in the financial markets are happening, and what we can do to position our portfolios to take advantage of, or at least ride out with some shelter to what's taken place in the equity markets, and discuss with Brad some of the opportunities in the bond markets now that we're seeing yields that we haven't seen in 10 or 15 years in bonds, and we can be very surprised and sometimes don't know how to react, but there are, in my opinion, some opportunities that we haven't seen in the bond market for a long time, and we should think about portfolios and repositioning portfolios for the long term now that the returns on bonds are competitive in some instances with stocks. Also going to talk about some words of wisdom on doing what we love, tie that into Warren Buffett and some of his thoughts on career choice and how we should approach each day. And then we'll talk about what we saw in the financial markets last week, and this week is going to be a big week, and we'll talk a lot about what to expect from the Fed this week and how we may want to react to that. And then we'll talk about some opportunities in the markets, in particular in a couple of different equities in the markets, and how we may want to position our portfolios specifically within different equity sectors. So how do we get where we are today? It's not that hard when you look back to see how we got here. It's hard to have predicted where we'd be today. It's easy to look backwards. So coming into COVID, we already had a fairly strong economy. We had some geopolitical policies that, with the benefit of hindsight, didn't help or added to some of the pain that we're seeing today. So coming into COVID, we had a mentality of beginning to onshore here domestically, which in of itself is somewhat inflationary. Policy in of itself may make a lot of sense given what's gone on between relations between the U.S. and some of our former cooperative friends like China. But the feeling has been that certain key products should be manufactured domestically. At the same time, we were reviewing our immigration policy and limiting the number of folks who could come into the country, both on visas for folks who had ability to add to some of our technology and information knowledge, but we were getting concerned that we were allowing too many people into the country, and we were already in the midst of limiting immigration. At the same time, our country was graying, and we had reduced fertility as men and women decided to start families later, have fewer kids, and all of that combining to have fewer people in the workforce. And then we had the war in Ukraine certainly affect the commodity markets and the ability for the world to get more natural gas and food products like grains. Oil, which was immediately impacted, wasn't as severely impacted long term. So those geopolitical situations collided with COVID, where we had the Federal Reserve and the government ease significantly. We had monetary policy bring interest rates down to zero, in many parts of the world below zero. And we had a federal government that was figuratively and literally handing out money These two factors collided when COVID ended, or ended is a strong word, but receded. Certainly, there are still folks every day struggling with COVID, and don't mean to minimize that. But by and large, the U.S. economy has reopened, and we are feeling the effects or the hangover of all of those stimulative policies colliding with the policies that were in place previously that were somewhat inflationary, and we have a super inflationary cycle that we are experiencing today. And the Fed is trying to give us medicine to ease this hangover and get us back to a base state. But it's proving a little bit more challenging than many had predicted, given the extent of the amount of funds that were released into the system, and given that we've also had federal policies that have added to some of the party. We've had the current administration have some student loan reform. We've had the CHIPS Act, where the government's going to be spending about $50 billion to onshore. All these policies in and of themselves may be good policies. And we've also had infrastructure spending passed. So independently, a lot of these things may look like they make a lot of sense, but you have to look at the grand vision, the whole picture. And when you look at the whole picture, you've got lots of stimulus from COVID, meeting policies on the fiscal level, onshoring, immigration, less fertility, graying workforce, war in Ukraine, all colliding at the same time together. And you've got the Federal Reserve being the sole army, so to speak, to fight the forces of rising prices, and that's the midst of the world that we are in today. Now, I don't think that all is as horrible as it sounds right there. The Fed has done a good job of raising rates, slowing the rate of inflation, which acts with a lag, but there are concerns, and serious concerns, and real concerns that have real merit, that the Fed may be going too far, too fast, given that they don't know the effects of the rate increases that they've already done, and the fact that the Fed is also engaging quantitative tightening, which is going to also slow the money supply, and this is leading to all this uncertainty that we see in financial markets, and also leading to this rise that we're seeing in interest rates. And that may be where the greatest opportunity lies, is in the bond market, if you believe that the Fed is as determined as they say they are in slowing inflation and causing the world economies to begin to see less increase in prices, then you may see that the bond market may be the place that you're going to see or look back and say, hey, that's where the best opportunity was. Of course, time will tell. So, backing all the way up, and some thoughts for the day before we get into where financial markets are today. I'm going to talk about some things that we can think of as we live our lives. And these thoughts come from Warren Buffett and his 4 words on how we can live a much happier life. And he says the biggest lesson on happiness that stands the test of time, and perhaps is especially apropos in this age of quitting or folks moving on to new jobs, and that is to do what you love. Warren Buffett said, I get to work in a job that I love, but I have always worked at a job that I loved. I loved it as much when I thought it was a big deal to make $1,000. I urge you to work in jobs that you love. I think you are out of your mind if you keep taking jobs that you don't like because you think it will look good on your resume. If you do what you love, you will be aligned with doing the things that you care about. When you do that, you will see that your work, your values, and the things that bring you purpose are all in alignment. Once you have purpose, then you will have passion, which comes from the desire to make a change or a difference, whether that's a difference for your customer, your business, or even the world. You will be out there with that enthusiasm. That enthusiasm will be contagious, and that enthusiasm and that contagion will breed success. You will build a network or a team around you of others who are like-minded and feel that they all belong to a team that is aligned and strategically moving forward. And finally, you'll have one of the most critical ingredients for success at your fingertips, and that is optimism. You will be very optimistic that you can effectuate change, that you can make the world a better place. It doesn't mean that you won't wake up every morning knowing lots of stuff is broken and is about to break, but you will be optimistic that you and your team are up to the task of tackling those challenges, of fixing those breaks, and making, whether it's your company or your team or the world, a better place. All right, let's move on to this morning here. Last week was a week where we saw losses in the equity markets in the 4 to 4.8% range, so one of the worst weeks in the markets in a couple of years. And this morning, things are starting out weaker. U.S. stock futures are falling this morning. This is ahead of the federal interest rate decision on Wednesday, and amidst concerns about the health of the U.S. economy. We are on pace right now for losses in our third consecutive session. The Dow is right now off its worst levels of the morning, and futures are indicating a open down 250 points. NASDAQ futures look to open down about 30 points, and actually, it's S&P futures are down about 30. NASDAQ futures are down about 100. S&P futures are looking to open significantly below the 3,900 level, which was cited as a critical support. We talked about that last week. And if the S&P were to break 3,900, which it looks like it's on track to do right now, there are some technicians who say that could set up a retest of the June lows, which were around 3660. So, what messages is the market sending to us amidst this continuing worries and sell-offs? One, the market is telling us that they are concerned about earnings season, which is kicking off, as I mentioned earlier, in a couple of weeks. Last week, we got a warning from FedEx that earnings are going to be dramatically lower than they had anticipated, largely on weakness in Asia and Europe. But this concern from a global company that has its tentacles in much of the world economy, saying that business is slowing down the magnitude that they expressed, is something that brought serious concerns to financial markets. Taking a look at the expectations for what we have this week, and that's that the Federal Reserve on Wednesday is going to raise interest rates by 75 basis points. Markets are pricing in 100% probability of a 75 basis point increase. And when I say that, that's because there's also a 20% chance that it'll go by a full point. So at least 75. There's actually an 80% probability of 75, and a 20% probability being priced in that the Fed may go 100 basis points. Now that interest rates are beginning to rise, Wall Street Journal this morning saying that these rising interest rates or rising bond yields are changing the calculus for stocks. The rising bond prices are changing the dynamic between stock yields and stock prices and bond yields and what bonds are paying to investors. After several federal interest rate increases, yields across the Treasury market are at multi-year highs. Fewer than 16% of S&P 500 stocks have dividend yields that are greater than the yield of the 2-year Treasury note, which is approaching 4% this morning. Right now, we are seeing the 2-year note is at a 3.93%. That's up 7 basis points. 10-year yield right now is at 3.48, up 3 basis points. As we take a look at this information this morning, fewer than 20% of stocks have dividend yields that is greater than the 10-year Treasury note. That's the lowest level since 2006. A lot of investors chose to take risk in the equity market because there was no return available anywhere else. Now's the time where people are thinking, do I really need to take that risk, said Cathy Nixon, Chief Investment Officer at Northern Trust. Traders see an interest rate increase as a foregone conclusion. But what do we have to look forward to at this Fed meeting? Well, critically important is going to be to watch the dot plot. With the expectations of another big increase at this meeting, the question facing the markets is how high the Fed will take interest rates before they pause or even start to lower them. The dot plot reflects the individual projections of Fed officials when it comes to the economy and interest rates. While these simply reflect expectations and don't set where policy will go, investors will be able to get a sense of the direction that Fed officials are anticipating in the future. Also, take a look at what the Fed has to say about the inflation outlook on Wednesday. Underlying it all will be the Fed's discussion of the outlook for inflation in the announcement, projections, and press conference press conference by Jerome Powell after the meeting on Wednesday will give some insights into his thoughts about future inflation. One critical question is how the Fed will characterize the latest inflation report. The question becomes how confident the Fed is that inflation will be trending down towards its 2% target. Also of critical importance will be the Fed's views on wage pressures. If the whole point of these interest rate increases is to bring about demand destruction, then we are going to have to see wage gains slow down, and it'll be insightful to hear what Chairman Powell has to say regarding what he sees currently and what he expects to see with respect to wages going forward. So in the news this morning, some important comments from President Biden. He was on 60 Minutes last night. In an interview, he said that the U.S. troops would defend Taiwan if China attacks them. But White House officials still say that it's not U.S. policy, but this is the second or third time that President Biden has said that the U.S. would come to the aid of Taiwan in the event of a China attack. This reiteration, after several murky backtracks in the past, is, in my opinion, somewhat of a game changer. He had time to think about the remarks he made to 60 Minutes. He was very clear and decisive with respect to those remarks. And in my view, they were somewhat of a true change in U.S. policy and something that had been hinted at in the past, so it wasn't a complete shock. But nevertheless, that is something the markets are going to digest over the next week or so, and markets will be monitoring Chinese comments following that strong statement from President Biden. President Biden on 60 Minutes on the economy said he thinks inflation will be controlled. He also said he thinks the pandemic is over. He said his firm decision on running in 2024 remains to be seen. That's also a change. In the past, he said he was certainly going to be running again. He talked about the federal income tax brackets for individuals and says he has no plans on proposing any changes to them. He spoke regarding the situation in Ukraine and suggested that the Chinese and India are removing themselves or distancing themselves from Russia. Most recently, as evidenced by some of their actions and comments at the gathering in Asia, where many of the world leaders from Central and Southeast Asia attended. President Biden also approved the Puerto Rico emergency declaration following landfall of Hurricane Fiona. Currently, Puerto Rico island is without power. In Taiwan, they had a 6.9 magnitude earthquake and tsunami warnings issued there. This morning, we are seeing Bitcoin falling below 19,000. And the Wall Street Journal is reporting that the Pentagon wants defense contractors to limit supplies from China. Companies in the news this morning: Adobe getting downgraded by multiple firms this morning after their announcement of a $20 billion acquisition last week, which was largely viewed as negative. The stock falling significantly, and this morning down another 5 points after some downgrades, including one from Wells Fargo. AutoZone, AZO, up about 2% this morning as they announced earnings and beat on revenues. In M&A news, Purple Innovation, a biotech company, PRPL, said it received an unsolicited, non-binding proposal to acquire all of its outstanding stock for $4.35 per share. Looking forward to what's going on this week. Today, we have the National Association of Home Builders releasing its housing market index for September, looking for a reading of 48.5, which would be even with last month. Wednesday, we get existing home sales for August. Those are expected to drop by about 100,000 to 4.7 million. Wednesday, we get earnings from General Mills and home builder Lennar. Then, of course, on Wednesday, the Federal Open Market Committee announcing its monetary policy decision, as well as the discussion with Chairman Powell afterwards. And we discussed the importance of that and what the financial markets will be looking for. Thursday, earnings from Costco and FedEx. Also on Thursday, the Bank of Japan announcing its monetary policy decision. The central bank in Japan is expected to maintain its ultra-low interest rate policy, keep its target rate unchanged at negative 0.1%. The dovish BOJ stands in stark contrast to the hawkish U.S. Federal Reserve, and as a result of their dovishness relative to our hawkishness, the yen has sunk to its lowest level against the dollar since 1998. Thursday, Conference Board releasing leading economic indicators. Those are expected to decline 0.1% after a decline of 0.4% last month. And then Friday, we get S&P releasing its global manufacturing and services PMI, looking for a reading of 51, and for the manufacturing services, and 45.3 for services. And those numbers compare with 51.5 and 43.7 respectively last month. So, as we take a look at Barron's and markets, Barron's talking about the carnage we saw last week. Dow down 4.1%, S&P down 4.8%, NASDAQ down 5.5%, and Barron's pointing to the fact that last week that the markets got the bad news from FedEx, driving home the point that the monetary policy decisions by the Fed, in combination with the rising commodity prices, are starting to have a real impact on the economy, and therefore those who had felt that perhaps the weakness in financial markets in earnings would be transitory, to borrow a phrase from the Federal Reserve, that those are looking to become more entrenched and permanent. If you're looking for a silver lining, things got so bad last week that on Tuesday, only 1% of stocks in the S&P 500 finished higher. That has happened only 28 other times since 1940. Silver lining is that when you had that much negative breath, that the index has gained an average of 15.6% over the following 12 months on average, and was higher 79% of the time. So you might say, well, is this a buying opportunity? Well, not so fast, because in those 21% of the time when things got bad, many of the times things got really bad because markets went from being oversold, as they arguably are now, to becoming super oversold, which can be a prelude to further declines. And when you have oversold conditions leading to extremely oversold conditions, you can get a situation that we've seen previously, and that would be a market collapse. So the odds of a market collapse are increasing. No way predicting a market collapse. The probability is that we don't get a market collapse, that we have a bounce back from oversold conditions. But when you have things that are this oversold, that is a possibility, and you have to factor that into your thinking going forward. In terms of when things may turn around, we have the Fed continuing to raise interest rates. If you go and look back at history, bear markets usually don't end, and bull markets usually don't start until the Fed starts easing. And typically, bull markets begin not after the first Fed ease, but the second Fed ease. And historically, when markets have rallied before the Fed begins to ease, typically you fall back into a bear market situation and get a double dip in equity prices. So all eyes, once again, on the Fed. How much higher are they going to raise rates? What's going to be the terminal rate? The terminal rate being the maximum Fed funds rate. Expectations are for a terminal rate somewhere between 4.4 and 5%. Markets right now are pricing in a terminal rate of 4.41%. Currently, Fed funds rate is 2.25 to 2.5, expected to go to 3 to 3.25 at the very least after the next Fed fund meeting. But what that means, if the terminal rate is going to be somewhere in that 4.40 to 5%, that the Fed still has a lot more raising to do, and therefore, if you look at history, this bear market may have more room to run. After the sell-off, one of the big expectations in the past has been, the Fed's going to ride into the rescue and going to do something to help out the equity markets. As we've learned in the last several months, this time is different than it's been over the last 10 years or since the financial crisis. The Fed, at this moment in time, doesn't appear to have the markets back. In fact, quite the opposite. The Fed is expected to keep raising rates despite the pain that these rate increases may inflict on the economy until they see the whites in the eyes of inflation and are going to be able to be confident that they have put that genie back into the bottle. Moving on to Barron's and a couple of thoughts about a couple of industries before I turn things over to Brad. The cover story of Barron's talked about the streaming businesses, something that just about all of us are familiar with as streaming services have become pervasive and one of the primary forms of home entertainment. And Barron's discussing what the future may be like for streaming services and where the opportunities may arise. And one of the key takeaways is that the future of streaming is going to be a future that looks somewhat more like the past of network television, which is going to include more advertisements, something that we previously didn't associate with streaming, which will provide lower cost services, but at the same time will take away some of our time in exchange for those lower prices. But one of the interesting thoughts regarding ads on streaming services is that they may change the dynamic in the advertising space because being able to provide ads on streaming services potentially enables a significant amount of targeting that doesn't exist with traditional network television or what some folks call linear television. So streaming services will be able to more effectively compete against the Googles and the Facebooks of the world, and this is an area that they may face serious competition within, as streaming services are able to gather lots of information about you and use that information to help advertising companies target ads towards you. The future of streaming and ads and getting the pricing right, though, is quite complicated and uncertain. So Barron's certainly expressing reservations regarding the ability of Netflix to do this in a way that will please Wall Street. Nevertheless, the potential opportunities are great and the potential pitfalls are great. And in reviewing this article, you'll be able to read the analysts who think they're going to nail it and the analysts who think that they're going to struggle. Some other companies that potentially could be beneficiaries of ads on streaming services are Trade Desk, which competes with Alphabet as an ad buying platform, and they've partnered with Disney in streaming advertising to target those ads to consumers. Microsoft is a big player. They've worked out a deal with Netflix. They are a rising ad player. And they could benefit from this move to streaming. And finally, some think that Roku, which stock price has collapsed, could represent a good opportunity to recover some of the losses that they've experienced as they are able to monetize advertising on their platform. Mention one final stock, and then turn things over to Brad. And this stock is Newmont Mining, which was written up in Barron's as a stock that's too cheap to ignore. Why it's time to buy. Newmont Mining is the largest miner of gold in the U.S. Out of any stock listed on the New York Stock Exchange. Gold has lost its shine of late, but gold producer Newmont might be a diamond in the rough. It hasn't been easy being a gold miner lately. Price of gold has been sliding since the top $2,000 an ounce in March. At the same time, the Federal Reserve has been raising interest rates, sending the U.S. dollar higher, and that combination has created a spiral downward for gold, and it's tumbled 19% from its highs. But Newmont Mining stock has tumbled a lot harder than that tumble in gold. It's down more than 50% from its April high. It's down to around $42.50 a share. Its lowest price since March of 2020, which was in the depths of the COVID sell-off, and at that time gold was selling at around $1,500 an ounce. Now gold is at around $1,665 per ounce. The company has been hurt by the same inflationary pressures affecting practically every business, and therefore the cost to extract gold has increased from around $1,050 an ounce to $1,150 an ounce, and that's one of the reasons the stock has been under pressure. Nevertheless, Barron saying now may be the time to buy Newmont stock. The dollar, one of the headwinds, is unlikely to rise forever. And owning gold does provide a hedge in the case of any significant potential geopolitical tremors or economic tremors. Newmont stock continues to increase its production of the precious metal. And it also carries a 5.2% dividend yield, which means that investors can get paid to wait. An analyst at Goldman Sachs, Emily Chiang, said recent underperformance marks an attractive entry point for a low-risk gold producer delivering volume growth. The symbol there is NEM, Nancy Echo Mary. That I'll turn it over to Brad to talk some more about the market that's certainly getting increasing focus and attention, the bond market. Good morning, Brad.
Good morning, Keith. Good morning, everyone. With the exception of 4 New York sports teams winning yesterday, a first in 13 years, it's definitely been tough to get up and at 'em on Monday mornings as a financial professional. My first call this morning was with Keith, who really did talk me off the ledge about the free fall of the markets. And we discussed that bonds have not looked this attractive in a long time. Keith understands investing and portfolio management. For me, as a trader, I'm looking at the daily marks to market, and that's not always the right way to look at things. The conversation with Keith truly reminded me that for many high tax state investors, 4% of municipals is still in many cases a better than 7% taxable equivalent yield, and over the course of history, that is a very nice return. Just one footnote, when the 10-year and 30-year were probably down about a point on both bonds, the 10-year is now down an eighth of a point, the 30-year is up an eighth of a point, meaning that there is interest here in bonds. On a personal note, I'm disgusted that there was a multi-year period where investors were forced to buy longer bonds or riskier assets in order to get any return at all. 2% munis that were bought with 20-year maturities made sense a year or two ago, but they're now in the portfolios sitting there down 30 to 35% in value. That's very frustrating. We just have to remember that the only silver lining on this is that you do get par at maturity. But it is difficult because people do want to look at their statements, and it is obviously a mark. Also, hearing about the equity market back then, Tina, there is no alternative. Well, now you have a heck of an alternative in bonds. In hindsight, last year, the best alternative would have just been keeping a lot of the portfolio sitting at zero. But who would have known how fast and furiously the Fed would have changed course here and started raising rates so aggressively. I was going to talk about municipal tax loss swaps and deep discount municipals this week, but I decided that I'm going to wait a couple of weeks on that now. The opportunity to buy longer-term 2 and 3% municipals could potentially be enormous, and if handled properly, could create equity-like returns. maybe better than equity-like returns. But on these bonds, I'd rather not try to catch the falling knife here. I've seen this happen several times in my career, and the opportunities can just be unbelievable. So please keep that in mind, that we will talk about that. During these tough markets, we're all here for each other, both for a financial discussion and as well as Keith did for me this morning, listen to another and possible very helpful opinion. And have a good week. And back to Keith. Thanks.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. This podcast is available on most platforms, including Apple Podcasts, Spotify, and Pandora. For more information, please visit our website at www.heroldlantern.com.
Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.